What are we going to learn?
You're going to learn why Herbalife is going to collapse.
Bill Ackman is on a holy war.
A couple times we come across a company we think is causing harm. We can make money betting against that company.
Herbalife stock goes down, we make money. Herbalife stock goes up, we lose money.
And that's short selling.
Two titans of Wall Street are locked into a very public fight. Hedge fund manager Bill Ackman stares intently into the camera from a remote studio, defending his billion-dollar bet.
This is not an honest guy, and this is not a guy who keeps his word, and this is a guy who takes advantage of little people.
And I'm telling you, he's like the crybaby in the schoolyard. You know, I went to a tough school in Queens, and they used to beat up the little Jewish boys, and he was like one of these little Jewish boys crying that the world was taking advantage of him.
The exchange is fiery and unprecedented. Billionaire versus billionaire, ego versus ego. Bill Ackman, convinced he's uncovered a corporate fraud, refuses to back down. He's shorted Herbalife, a nutritional supplements company, and loudly called it a pyramid scheme.
They came up with is they call the bottom of the pyramid strategy. And it was a strategy where they decided to target the poorest people in the world. I mean, it sounds incredible, but true.
Icahn, smelling blood, has taken the opposite side. On live TV, Ackman keeps his composure, even as Icahn hurls insults. He's confident in his research, perhaps too confident.
Well, what I can tell you is this is not an honest guy, and this is not a guy who keeps his word, and this is a guy who takes advantage of little people.
Okay? So let's start with what I want to say. Ackman is a liar, okay? Ackman does pump and dump. He's got one of the worst reputations on Wall Street, and I'm going to tell you this Herbalife is a classic example of what he does, and he's basically lying.
In this high-stakes showdown, the normally composed Ackman has bet his reputation and $1 billion of his hedge fund's money on a single trade. It's a defining moment in his career, but it's not the first time Ackman has courted controversy for a big bet, nor will it be the last. How did we get here? To understand, we must rewind to the beginning of Bill Ackman's rollercoaster journey through the world of high finance. Bill Ackman's story begins far from the spotlight of CNBC. Born in 1966 to a wealthy real estate family in New York, Ackman showed ambition from an early age. By the time he graduated Harvard and later Harvard Business School, his sights were set on Wall Street. Just 26 years old, Ackman boldly launched his first investment fund, Gotham Partners, straight out of business school.
Actually, my father, who's here, he told me it was a really dumb idea to start an investment fund right out of business school.
He had no established track record, just confidence and a knack for shaking up the status quo, traits that would define his career. Gotham Partners had early successes, but ultimately stumbled. A series of illiquid investments and prolonged regulatory battle sent the fund into collapse by 2003. It was a humbling setback for the young investor, but definitely not the end of his story. Ackman later said the key was that he preserved his reputation through the ordeal. Indeed, instead of retreating, he used the lessons from Gotham's failure as fuel for a dramatic comeback.
I was thinking about starting my own investment firm, and I asked Richard what he thought of the idea. He said, "You know, Bill, you don't need to be old to be right." That was enough for me, and I started an investment fund.
Less than a year later, in 2004, Bill Ackman raised $54 million to start fresh with a new hedge fund, Pershing Square Capital Management. Pershing Square would embody Ackman's bold, activist approach to investing. From the outset, Ackman's strategy was to make big, concentrated bets and agitate for change. "My first rule of activist investing is to make a bold call that nobody believes in," Ackman has said. And bold calls he made. Early on, Pershing Square scored huge wins by targeting undervalued or underperforming companies and shaking them up. One of Ackman's first triumphs came when Wendy's in 2005 had amassed a stake in the burger chain and pressed management to spin off its Tim Hortons coffee unit. The result? Ackman turned a $100 million investment in Wendy's into about $380 million in just a year and a half. His lobbying led Wendy's to shed assets, reward shareholders, and unlock value. Ackman's knack for spotting value and catalyzing change earned him rising star status. He took on McDonald's and even waged a proxy fight at Sheridan to break it up. Perhaps most cannonly, in mid-2000s, Ackman set his sights on a seemingly untouchable financial giant, MBIA, a bond issuer. At a time when few saw trouble on the horizon, Ackman spent years warning that MBIA's business was a ticking time bomb of risky credit exposure. He quietly shorted MBIA's debt, enduring ridicule as a doomsayer until the 2008 financial crisis proved him right.
The company accused us of spreading false and misleading information about their business. MBIA took 7 years for us to be proven right. And ultimately, the company collapsed during the credit crisis because of exposure to subprime mortgages.
When the housing bubble burst, MBIA imploded exactly as Ackman predicted, vindicating his crusade and reportedly earning him a fortune. This early victory cemented Ackman's reputation as an intensely analytical and fearless contrarian, willing to go against the grain for a conviction bet. By 2011, Bill Ackman was riding high. Pershing Square's assets swelled and its returns dazzled, averaging 34% per annum in the fund's first year. The financial press dubbed him a baby Buffett for his value investing flair and growing billionaire status.
Well, you've known Warren for decades and decades. Bill Ackman likes to be considered a baby Buffett.
Yet Ackman's aggressive style also earned critics. Some called him arrogant for his activist campaigns and media bravado. But there was no denying his impact. As one early investor put it, "This isn't rocket science. People give us money and we give them more back." Ackman said, matter of fact. In late 2012, Bill Ackman set his sights on a new target, one that would pit him against a powerful company and a fellow billionaire.
A reporter named Christine Richard at Bloomberg News got interested in the story and then ended up writing a book about my battle with MBIA called Confidence Game. And then she joined an independent research firm to focus on short ideas, companies to bet against. And she called me one day and said, "Bill, I think I've got the next MBIA."
The company was Herbalife, a global nutritional supplement seller using a multi-level marketing model. To Ackman, the numbers didn't add up. He believed Herbalife was a pyramid scheme, preying on hopeful distributors, and he decided to prove it to the world. In December 2012, Ackman unveiled a massive research report and a 3-hour presentation that absolutely gutted Herbalife's business practices.
This will be the most important presentation that I've made in my career. So how's that for raising expectations?
What are we going to learn?
You're going to learn why Herbalife is going to collapse. And that's a pretty strong statement, but this is the largest fraud in terms of scale, of countries involved, harm to people.
He revealed that Pershing Square had quietly shorted $1 billion worth of Herbalife stock, an unusually large and very public bet against a single company.
How much money have you spent betting against Herbalife?
We have a short position of over $1 billion.
This public short position was unprecedented in scale and display. Hedge funds often short companies, but they rarely announce it so flamboyantly, since going public could invite a squeeze. Ackman, however, was convinced he was right and wanted regulators to take notice. Herbalife's stock plunged initially as news of Ackman's short spread.
We've sent her a legal letter. This is a ridiculous assertions by people who are trying to manipulate our stock.
What would you say to those who say that you are trying to manipulate the success of the company and therefore the stock price?
We simply want the truth to come out.
But the company's executives denied the pyramid scheme allegations, and they found an unlikely champion in one of Ackman's longtime rivals, Carl Icahn.
We're not a pyramid scheme. That's a bogus accusation.
This is anecdotal. It's very propaganda-based. What he's missing is that fundamentally, we've got millions of customers that enjoy the product, that use the product. That's indisputable.
The bad blood between Ackman and Icahn ran deep, dating back to a deal years earlier that had ended in lawsuits and bitterness. Now Icahn saw an opportunity. In early 2013, just weeks after Ackman's short campaign began, Icahn started buying Herbalife shares aggressively, publicly challenging Ackman's thesis.
Most guys on Wall Street I sort of like and I get along with, and it's no secret I don't like Ackman. I don't respect him and I don't like him, and that's not a secret.
By May 2013, Icahn had built up a 16% stake in Herbalife, lending the company support and driving its stock price back up.
Some people have said this is sort of the ultimate short squeeze. We've got a stock now. It's up 20% year to date.
Ackman has given us an opportunity to buy a company at a discounted price. And for that, I thank him, actually.
The clash quickly turned personal and spilled into the open, finishing in that explosive January 2013 CNBC confrontation we saw in the opening. On live television, Icahn lambasted Ackman's tactics and motives. Going public with this is going to force you into the mother of all short squeezes, Icahn warned, essentially predicting Ackman would be crushed as Herbalife stock rose. Within months, Herbalife stock, which had dipped into the $20, surged to over $80 amid buybacks and Icahn support.
Why is the stock going up?
Simply because Carl Icahn and others have been promoting it. That's why. Ultimately,
meaning that the people investment community is believing Carl Icahn more than they're believing you.
Sure, certainly on this investment. That's the case.
Ackman's short position was deeply in the red. By late 2013, it was down roughly $500 million on paper. Still, Ackman refused to cover. He doubled down on his research, spent a staggering $15 million on a PR campaign to expose Herbalife.
Is this the most important deal of your life?
This is not a deal.
Is this the most important campaign?
I would say if we are successful in shutting down Herbalife, we will save a very large number of people from enormous harm.
He went on to lobby regulators to investigate the company's practices. This crusade was as much PR battle as financial bet, unprecedented in the hedge fund history. Icahn, enjoying the pain he was inflicting on Ackman, even joined Herbalife's board and held on to his stake.
Carl can try to orchestrate a short squeeze. He can try to scare my investors from investing with me, which it sounds like he's attempting to do on this call.
Ackman takes it one at risk. But what the hell? He's not risking his money, he's risking his investors' money. And I'll tell you, this could be the mother of all short squeezes.
Finally, in 2014 to 2016, multiple government agencies did look into Herbalife, but the outcome was not the knockout blow Ackman hoped for. In July 2016, the Federal Trade Commission settled with Herbalife. The company agreed to pay a fine and restructure some practices. But crucially, it was not shut down or declared a pyramid scheme.
It's a case of good news, bad news. For embattled company Herbalife, the Federal Trade Commission will not classify it as a pyramid scheme, but in return, Herbalife will pay a settlement of $200 million.
By that day, Ackman's fund was estimated to have lost about $500 million on the short. The tide had turned decisively against him. After more than 5 years of relentless battle, Ackman quietly began scaling back. By late 2017, he covered the short position, reportedly near a $1 billion total loss at exit, and switched to cheap put options to limit further damage. In February 2018, Bill Ackman finally admitted defeat and closed out his Herbalife bet completely. The Herbalife saga was a public humiliation for Ackman. This charismatic stock picker who once seemed infallible had been bested in a very visible way. Even worse, from Ackman's perspective, Carl Icahn walked away the victor, eventually selling his Herbalife shares at a hefty profit. For Ackman, the episode offered harsh lessons about the dangers of publicly short selling. In 2014, even as the Herbalife drama raged, Ackman made another bold bet, this time on the long side. He invested billions into a fast-growing pharmaceutical company called Valeant Pharmaceuticals International. Valeant, led by CEO Michael Pearson, was a Wall Street darling known for acquiring dozens of drugs and raising their prices. To Ackman, Valeant looked like the Berkshire Hathaway of pharma, a compounding machine of acquisitions and cash flow. By early 2015, Pershing Square had spent about $3.2 billion to acquire a major stake in Valeant, eventually owning 30 million shares, including options. Ackman even joined the Valeant board, confident he could help steer the company to even greater heights. In mid-2015, cracks appeared in Valeant's face. Reports emerged of unsustainable business practices, outrageous drug price hikes, phantom sales through specialty pharmacies, and mounting debt. By early 2016, Valeant's stock went into freefall as regulators and Congress turned their gaze on its tactics. The stock collapsed more than 90% from its peak, and Ackman's losses ballooned into the billions. Pershing Square sold its entire Valeant stake for roughly $300 million, a staggering loss of over $4 billion from what the fund had invested. For a single position, it was one of the biggest losses in hedge fund history. Ackman wrote to his investors that he was deeply and profoundly sorry for the disaster. It was almost an unheard of apology in the macho world of hedge funds. In the span of just a few years, Ackman's image morphed from wonder kid to cautionary tale. How had the golden boy of activism flown so close to the sun? Ackman himself reflected on this painful period with unflinching openness. At an investment conference in May 2017, a visibly humbled Ackman told the audience, "We picked the wrong business. I had not expected Valeant's business to be as unstable as it had turned out." He likened the experience to touching a hot stove. When you put your hand in the fire and you get burnt, you get back to a real focus on your core. To observers, Ackman seemed punished but not defeated. He announced Pershing Square would return back to basics. Little did he know that redemption would come faster and more dramatically than anyone expected, courtesy of an unexpected global crisis.
I do right now, though, want to bring in Bill Ackman on the phone. He took to Twitter today to urge the president to take more dramatic measures to stop the spread of the virus. Bill, I thank you for joining us today.
In the winter of 2020, whispers of a novel coronavirus turning into a pandemic began rattling markets. Many investors hoped it would blow over. Ackman, however, sensed a coming storm. The memories of 2008 were etched in his mind, and he had recently watched the thriller film Contagion, which gave him an eerie feeling of what might unfold. Ackman realized that if COVID-19 went global, the economic fallout could be catastrophic.
And I felt, it's really, I've never had this experience before in my life. The closest I had was the financial crisis where I'm saying, things are coming, bad stuff's coming. But this was a feeling like I've never had. Like there's a tsunami coming, right? The tsunami's coming in, you feel it in the air.
So while others stayed complacent, he quietly devised an insurance policy to protect Pershing Square's portfolio.
During the past 10 days, we have taken steps to protect the portfolio from downward market volatility. We have done so because we believe that efforts to contain the coronavirus are likely to have a substantial negative impact on the US and global economies, and on equity and credit markets.
In late February 2020, Ackman began buying credit default swaps, essentially hedges against corporate bonds, to wager the credit spreads would widen dramatically if the economy shut down. This hedge wasn't cheap. Pershing Square spent about $27 million in premiums. But Ackman calculated that if the market plunged, those swaps would soar in value, offsetting losses on his stock holdings. It was a bold move. Rather than sell his favorite companies, he hedged them. By early March, as COVID cases exploded in Europe and the US, financial markets began to panic. Pershing Square disclosed its hedge on March the 3rd, and within days its value exploded. As credit markets seized up with the stocks cratered, Ackman's foresight paid off beyond all expectations. By the 13th of March, the hedge had swelled and Ackman started closing out portions to lock in gains. In less than a month, that $27 million position grew to be worth an astonishing $2.6 billion. Yes, $2.6 billion, a roughly 100-fold return in a matter of weeks. It was perhaps the single greatest trade of Ackman's career, coming at a moment of global despair. Pershing Square's public fund actually finished plus 7.9% in March 2020, while the S&P 500 fell a staggering 17%. On March 18, 2020, he phoned into CNBC from his home, sounding on edge and near tears. In an emotional 28-minute live interview, Ackman delivered a dire warning.
He's not saying, he's not saying to storm the beaches at Normandy, right? He's saying, go home. Go home. Spend a month with your family.
If we don't do this, America will end as we know it. Stocks plunged further during and after his interview, and Ackman's emotional delivery became one of the defining moments of the early pandemic. Almost immediately, critics pounced. Some accused Ackman of intentionally sowing panic to profit from his hedge. After all, here was a hedge fund manager publicly preaching doom while he had bets that would gain from a market crash. And importantly, by that time of his CNBC interview, Pershing Square had already closed out much of that hedge. In fact, just 5 days later, on the 23rd of March 2020, Pershing Square announced it had fully exited the remaining hedges, locking in the $2.6 billion windfall. Ackman then swiftly redeployed most of that capital into the stock market at distressed prices. In his words, he went all in on an American recovery. Ackman was effectively saying, I've seen the abyss, but now I'm betting on the rebound. It was a spectacularly timed maneuver. Hedge the crash, then double down at the bottom. By year end, Pershing Square's main fund was up over 70% in 2020. One of the best performances of any major fund that year. Ackman himself downplayed it as simply insurance and good luck, but there was no denying that in the span of 3 years he had gone from rock bottom to roaring comeback. He'd apologized for past mistakes, refocused his strategy, and then delivered one of the greatest trades of a generation when it mattered the most. By 2021, Pershing Square's assets were climbing again, and Ackman's personal net worth, which had dipped after the Valeant fiasco, soared to new heights of over $9 billion in 2024. His portfolio became a mix of high-quality businesses like Domino's Pizzas, Hilton Hotels. These reflected more disciplined, long-term focus. True to his word, Ackman largely avoided the media limelight during this stretch, letting the results speak for themselves. That's not to say that Ackman stopped swinging for the fences. In early 2022, he spotted another bold opportunity, this time in beaten down shares of Netflix. The streaming giant stock had cratered after a bad earnings report, and Ackman saw a chance to buy a great business at a discount. In January 2022, Pershing Square plowed $1.1 billion into Netflix, acquiring about 3.1 million shares.
This morning, Bill Ackman has now taken a stake in Netflix. The billionaire hedge fund manager saying he bought more than 3.1 million shares after the stock had plunged last week. That makes him a top 20 shareholder. In a tweet just yesterday, Ackman said, quote, I have long admired Reed Hastings and the remarkable company he and his team have built. We're delighted that the market has now presented us with this opportunity.
But just 3 months later, Netflix shocked the market with news that it lost subscribers for the first time in a decade. The stock went into free fall, dropping 35% in a day. Ackman was faced with a tough decision: hold on and hope or cut losses quickly. The very dilemma he had gotten wrong with Herbalife and Valeant years earlier.
The guy in the past probably would have doubled down. And frankly, yesterday when I saw the huge slide, I was thinking to myself, boy, I wonder if he's buying more, because the old Bill would have bought more. And he would have told you all the reasons.
This time, Ackman didn't hesitate. In April 22, Pershing Square liquidated the entire Netflix stake, taking a loss of more than $400 million. Ackman explained to his investors that Netflix's business had become too unpredictable. In other words, he'd rather admit defeat early than ride another position into the ground. This quick about face surprised some. It was uncharacteristic for the famously stubborn Ackman to fold so fast, but others saw it as a sign of maturity and discipline earned through past mistakes. Ackman was no longer investing with ego, he was investing with pragmatism. And by 2025, Pershing Square was exploring new ways to grow, even considering an IPO for the fund. And Ackman had taken public stands on issues from corporate governance to geopolitics. He had in many ways become an elder statesman of the hedge fund world, albeit one who still thought like a hungry underdog. Perhaps the most telling sign of Ackman's comeback is how he's viewed by his peers today. Back in 2008, many of Wall Street had written him off as a cautionary tale of overreach. But now, after a string of successes and a legendary crisis trade, Ackman's clout is restored. He's once again one of the most closely watched investors. When he speaks on economic issues or posts his market thoughts on social media, people listen. The journey has transformed him from brash activist sniper to something of a battle-tested veteran. Today, Pershing Square stands strong, and Ackman continues to search for the next great opportunity. The next bold call nobody believes in. This final analysis of Bill Ackman's journey is a Wall Street epic, a reminder fortune favours the bold, but survival favours the wise. Whether he's hailed as a hero or a villain often depended on the chapter of the story. But through all the twists and the turns, Ackman never stopped betting on his convictions and ultimately betting on himself. As the curtain falls on this chapter of his career, one can't help but wonder what bold moves comes next. If history is any guide, Bill Ackman will be ready, armed with the lessons of the past and unafraid to seize the future. I hope you've enjoyed this absolutely thrilling episode about the career of Bill Ackman. If you want to find another fantastic story, then be sure to check out this video here on the screen of George Soros and his $1 billion trade. Thanks for watching, everybody. Make sure we thumbs up, comment and subscribe. And in the description, if you want to join my free investment newsletter, then be sure to do so, and you can find out what stocks I'm buying. Thanks for watching, guys.